Are you ready for the biggest changes to Australia's age pension in years? From income boosts to new eligibility rules and a mysterious $3,900 Centrelink update, this could change everything for your retirement. Hi, everyone. Welcome back to the channel. If you're planning to retire soon, already receiving the age pension, or just want to stay ahead of the game, this is a video you don't want to miss. Today, we're breaking down everything you need to know about Australia's age pension changes coming in 2025. We'll cover new payment rates, important shifts in income and asset thresholds, what's happening with superannuation, and yes, the truth about that $3,900 Centrelink boost everyone's been talking about. So, grab a coffee, get comfortable, and let's walk through what this all means for you and your future. Hello, everyone, and welcome. Today, we're diving deep into some very important updates regarding Australia's age pension system in 2025. These changes could have a major impact on retirees, those nearing retirement, and even younger Australians planning ahead. We'll go over the new age pension rules, income and asset thresholds, superannuation updates, and of course, the much-talked-about $3,900 Centrelink update. There's a lot of useful information here, so make sure to stick with me until the end. Let's begin by understanding what the age pension actually is. In Australia, the age pension is a government-funded payment that provides financial support to older Australians who meet specific criteria around age, residency, income, and assets. It's designed to help people live with dignity and stability once they retire, especially those who may not have enough income or savings to support themselves fully. Now, to be eligible for the age pension, you must meet a few key conditions. The first is age. As of now, and continuing into 2025, the qualifying age for the pension is 67 years. That means if you were born on or after 1 July 1957, you can apply for the age pension once you turn 67. The second condition is residency. You must be an Australian citizen or a permanent resident and have lived in Australia for at least 10 years, with at least 5 of those years being continuous. This ensures the pension supports people who have contributed to the country for a reasonable period. But meeting the age and residency criteria doesn't automatically mean you'll get the full pension. The system also uses what's called a means test, which includes both an income test and an assets test. These determine whether you qualify for a full pension, a part pension, or nothing at all. Now let's get into what's changing in 2025 and how it might affect you. First and foremost, there's good news for many pensioners, an increase in payment rates. From 20 September 2025, the maximum fortnightly payment for a single person receiving the age pension will increase to $1,178.70, which is a $29.70 revised cent. For couples, each partner will receive $888.50 per fortnight, an increase of $22.40. That means a combined payment of $1,777 every 2 weeks. On top of that, the maximum rent assistance will also increase. Single renters will now receive up to $215.40, and couples will get $203. These increases are indexed to inflation and reflect the rising cost of living across the country. So far, this is promising, but the changes don't stop there. The income test thresholds are also being raised. This is where things get interesting, especially for those who are still working part-time or have investments. The income test looks at how much money you earn from work, investments, rental income, and other sources. Based on your total income, Centrelink calculates how much pension you're entitled to. In 2025, the new upper income limit beyond which the pension stops entirely will be $2,575.40 per fortnight for a single person and $3,934 for a couple combined. If your income falls below these thresholds, you may still be eligible for a part pension, depending on how much you earn. Now Centrelink allows you to earn a certain amount called the free area before they start reducing your pension. Once you go over this limit, your pension is reduced by 50 cents for every dollar of income. For example, if you earn $100 over the threshold, your pension will be reduced by $50. This taper rate remains the same, but the thresholds being lifted means more people can earn more without losing their pension. This change is particularly beneficial for semi-retired individuals who continue working part-time or have modest investment income. It gives you more flexibility to supplement your pension without being penalized too quickly. Next, let's talk about the assets test. This is the other half of the means test and just as important. The assets test assesses the value of everything you own excluding your primary residence. This includes bank balances, investment properties, shares, vehicles, and other valuable assets. If your total assets exceed a certain amount, your pension could be reduced or even cut off. In 2025, these asset limits are also going up. For single homeowners, the new limit will be $714,500. For non-homeowners, it will be $972,500. For couples who own their home, the combined limit will be $1,074,000, and for non-homeowners, it will be $1,332,000. These higher thresholds mean that people with a moderate amount of savings or investments will be more likely to qualify for some level of pension. This is a win for people who have worked hard to save over the years, but were previously disqualified from pension payments because their assets were just a little too high. However, for those with significant investments or multiple properties, the assets test will still limit or eliminate their eligibility. An important detail to remember here is that your primary home, the one you live in, is exempt from the assets test. So even if your house is worth over $1 million, it won't count against your pension. But if you own a second property or an investment apartment, that will be included in the asset assessment. Let's also touch on deeming rates. These are used by Centrelink to calculate the income you supposedly earn from your financial assets, even if you're not actually receiving that income. So, for example, if you have $100,000 in a bank account earning low interest, Centrelink might still deem that you're earning a certain amount based on set rates. In 2025, the deeming rates are being updated again. The lower rate will remain at 0.75%, and the upper rate will be 2.75%. These rates apply depending on how much you hold in financial assets and your household status. This change is relevant especially for those who have money in savings, term deposits, or investment portfolios. A higher deeming rate could reduce your pension even if your actual returns are lower. Then we have changes coming to superannuation and retirement saving structures. Starting 1 July 2025, the superannuation guarantee, which is the compulsory contribution your employer makes to your super fund, will rise to 12%. This is part of a long-term plan to help Australians retire with more financial security. There's also a change to the transfer balance cap, the maximum amount of money you can transfer from your super fund into a retirement income stream. This cap will increase to $2 million in 2025, up from $1.9 million. This change will benefit those with higher super balances who want to move more money into the tax-free retirement phase. Now, let's address the elephant in the room, the so-called $3,900 Centrelink update. You might have seen headlines or videos claiming that there's a one-off payment or bonus worth $3,900 coming your way. So, is it real? The short answer is not exactly. There isn't an official statement from Centrelink or Services Australia confirming a lump sum payment of $3,900. Instead, what's likely happened is that this number has been calculated based on the cumulative benefits of all the changes we've just discussed. For example, a $29.70 fortnightly increase adds up to about $771.60 annually. Add in rent assistance increases, income threshold improvements, and other supplements, and it's possible that some people could receive an overall boost worth around $3,900 over the year. But it's not a one-off check or cash bonus. It's the result of several adjustments combined. That's why it's important to understand your own situation. Every pensioner's income, assets, and living circumstances are different. What might result in a $3,900 benefit for one person could mean a smaller or larger amount for another. To get an accurate picture, you should use Centrelink's official online calculators or consult a financial planner who specializes in retirement planning. So, who stands to benefit most from the 2025 age pension changes? First, people who earn a modest income from part-time work or investments will likely benefit from the higher income thresholds. They'll be able to keep more of their pension while continuing to work or receive income. Second, people with moderate asset levels will benefit from the increased asset test limits, which will let more people access full or part pensions. And third, retirees who have been carefully growing their superannuation balances will benefit from the increased transfer cap and higher employer contributions. But some people could lose out, too. Retirees with high-value non-home assets may still be excluded from the pension. Others who are asset-rich but income-poor, for example, someone who owns a high-value property but has little income may struggle to access support. And newcomers to Australia, or those who haven't lived in the country long enough, may find themselves ineligible due to the residency rules. So, what should you do now? First, review your current age pension status. If you're already receiving the pension, these changes might mean your payment will increase, or you may become eligible for more assistance. If you're not receiving it yet, you should check whether you qualify under the new rules. Use the tools available on the Services Australia website or speak to Centrelink directly. Second, make sure your income and asset information is accurate and up to date. Thanks for sticking with me to the end. As you can see, 2025 brings some big shifts in how the age pension works, and knowing these changes could help you make smarter retirement decisions. If this video helped you understand the new rules, make sure to give it a thumbs up and subscribe for more updates like this. Have questions or want to share your experience with Centrelink or retirement planning? Drop a comment below. I'd love to hear from you. Take care of yourselves and your future, and I'll see you in the next one.